So today we are going to look at digital currencies. We were going to have the lecture Tuesday and Wednesday, and I think there were power cuts and people weren't able to join. So we decided not to have it. We will continue the lesson that we had. So the previous time we looked at Bitcoin and we looked at blockchain technology, and there we looked at the positive aspects of Bitcoin, about how it brought about blockchain technology and the benefits that were there, the good features in blockchain technology that have been used subsequently in many of the financial services. So today we are going to look at digital currencies, how that triggered a whole new type in the sense of physical or a form of currency, which is digital currency, and which we didn't have all this time. What we had was e-money. And e-money is basically a representation or an indication of an amount of money that is stored somewhere else, that is money that is stored in a bank account or in a digital wallet or something like that. But that is not money in itself. So in the e-money, what goes across is a message. In digital currency, there is an actual digital token or a digital representation that gets moved around. The ownership transfers, right? Just like cash, the note, the ownership transfers. Now let's go to the presentation. If you have any questions, you can stop and ask. I'm going to continue this without any questions or sort of any discussions, because I'm not sure about how your participation is in with current and all these things. So I'm just going to continue. If there's anything that you can't understand or you want to ask me, just feel free to stop and ask me, right? So otherwise, I'm not going to sort of wait and ask your questions and probably I'll just ask whether you are okay, but with how it's going, and you can obviously answer. But if there's something that you can't understand, just feel free to ask the relevant questions. This is a very, very new topic, and I kind of didn't have the sort of we were discussing whether to have a recorded session or not, and I thought I'll have an actual lecture, because this is a very current topic, and it's a topic that is continuing to grow, so it's very, very relevant. It's very relevant to banks as well, and people in general. So that's why I wanted to have a live lecture. But so if you have any questions, ask. As always, you're welcome. But if not, I'm just going to continue. So that is, I'll do it at a sort of a slow pace, so that anyone who is listening to the recording can understand. But yeah, that's how I will do it, simply because the participation is relatively low. So, okay, so we start with the term digital currencies. So what are digital currencies? It's very simply put, it's currencies that can be accessible only via an instrument that you can access some digital thing, right? So you can't if you take a Bitcoin, you can't go to an ATM and take Bitcoins out, right? There is nothing sort of that doesn't make sense, because by nature it is a digital thing, right? You can convert it and take USD out, right? That's a different thing. You're taking USD out. But here, it's by definition, the form is digital, right? Um, so digital currencies, the main sort of concept in digital currencies is that you don't need an intermediary, you don't need a bank. You can do peer-to-peer transactions, just like cash, currency notes and coins, right? Currency notes and coins, when we transact with another person, it is a peer-to-peer transaction, right? Now, if we look at this slide, we can see, let's look at the money flower first. This is a paper by the Bank of International Settlements, right? And you can see now it's based on the color, right? So if something is peer-to-peer, it's in the orange petal, right? If something is central bank issued, then it is in the blue petal. Electronic, that is the mode, is it electronic or not electronic? So the other word for electronic nowadays is digital, right? So it's green, and then the maroon one is how can you access? Can everyone access the money, right? Now, when you take the type of money that falls into all these categories, right, are central bank digital currencies, right, which can be virtual, right? It can be electronic. It's universally acceptable because it is issued by the central bank, right? It's peer to peer, and yeah, so it's digital. We've covered all the four petals, right? Now, if you take peer to peer, you can see that cash is also inside peer to peer, right? Cash is also universally acceptable, right? Now, if you take bank deposits, if you have a bank account, it is universally acceptable, right? Now, if you take virtual currencies, now we discussed this in the last lecture, they are not issued by a central bank, right? So they're not issued by a central bank, they are issued privately. So that's why it's outside the blue petal of the central bank, right? It's not inside that. And if you take cryptocurrencies again, they're a subset of virtual currencies. So they are also outside the central bank issued pedal, right? But if you take the universal acceptability, you can see that all virtual currencies are not universally accessible, but all cryptocurrencies, anyone with a computer, with a mobile phone can use cryptocurrencies. That's not a problem, right? Um, and then you have local currencies. In our very sort of first lecture, we discussed this about how you can have local currencies. And this is the local, that is, people in one geographical area can decide, okay, we are going to use gems as our currency. They can have a local currency, or they can have I don't know, the gold coin or something like that. You can have it. It is possible because the acceptance for a money, something to be money, is acceptance, right? So if everyone accepts something as money, then it is money, and they can use it as they please. So that is what we have done as countries and as human beings. We have accepted notes and coins as money, right? The day we stop accepting that, it loses that core requirement, right? So um, so now when we look at digital currencies, right? So now we are looking at this group, right, in the green petal, right? So this is from an IMF study. So the digital currencies is the bigger umbrella, right? It's like the top of the umbrella or top of the funnel, and then it kind of comes down. So when we are looking at digital currencies, we must always look at the other side. So digital versus non-digital, right? So non-digital would be things outside this petal, right? So it is digitally represented. And because it's the money is digitally represented, you can access it through your computers or mobile phones, right? Now, you have uh, things like e-money, which can be, someone could consider this as e-money, as digital currencies, right? Uh, because it's called electronic money, but it is not, it is again sort of an indication of money stored elsewhere, right? Now, when the money is stored in the PayPal account itself, it becomes e-money. Now, in some countries, it's called issuing e-money, right? When money that goes into things like PayPal accounts, PayPal wallets, right? Now, within digital currencies, there is things called virtual, right? Now, virtual currencies are things that are not denominated in legal tender. Now, that is important. Now, what is legal tender? Legal tender is the official currency legally accepted in a country. Now, in Sri Lanka, it is rupees. In the US, it's US dollars. In UK, it's the sterling pound, right? So, those are the legal tenders. Now, virtual currencies are not legal tender generally, right? Because it's not a actual currency. That's why we call it virtual currency. It's sort of almost like currency. Like virtually, it's a currency, right? It is in a digital form, but it's not only that. When we use the word virtual, it also means sort of the colloquial meaning of virtual, right? It's virtually a currency, but it is not legal tender. Then inside that, under virtual currencies, the convertibility. Can you convert it to goods and services or money, right? Then there are things that are not convertible. Those are things that are sort of in, if you go for like computer games and stuff, they also give coins, right? If you play computer games, you will see that you win after you pass a certain level, or finish a series of tasks. They give you coins which you can used to sort of replay the game or to buy lives in the game or something like that. Those cannot be converted in, you can't go to outside that game and use that to buy things, right? So they're just sort of nominally, they're just called, by namesake, they're called coins, right? Because they function as a coin within that game, right? Within that little ecosystem, it functions as a coin. What is convertible is the money that we use is convertible. We can give it and convert it into goods and services. We can convert it into other currencies, right? So then you have whether it's convertible or not. So convertibility within virtual currencies, there are things called convertible virtual currencies, right? And then the other one is decentralized or centralized, right? So decentralized means, again, it's private, right? There is no central authority issuing the money, right? So it can be issued by any person, right? And so that's what happens with Bitcoin. Anyone who runs the hashing process will get Bitcoins, right? Then within the decentralized category, you have cryptocurrency. So cryptocurrency are currencies that use cryptography to validate the nature of the coin, right? So what are virtual currencies? So one focus, we will be focusing on virtual currencies. We'll be looking at virtual currencies, and then looking at how virtual currencies kind of came up in the world, and then the subsequent developments to virtual currencies, right? Um, so far, are we okay? Are we okay so far? If you have any questions, please feel free to stop and ask. As I mentioned at the beginning, I won't be sort of asking you all and waiting for answers because of this electricity problem and all of that. People are coming and going. So I'm just going to continue. So if you have any questions, or if I'm going too fast, just let me know. Right? Virtual currencies are sort of the core of digital currencies. I mean, that's where the whole thing starts, right? So virtual currencies are digital representations of value issued by private developers and denominated in their own unit of account, right? So now we have certain characteristics in currencies here. Digital representations of value issued by private developers, right? So not the central bank, denominated in their own unit of account. That means like Bitcoin will have the bits, right? The BTC, and that is the way that Bitcoin. And then each coin will have its like rupees and cents, uh, pounds and pence. You will have it's a fully formed currency in every sense, in the sense conceptually, except that it is not issued by a central authority, it is issued by private individuals, right? They are issuing their own currencies. So what another sort of a longer, more detailed definition of virtual currencies is virtual currencies is a digital representation of value that can be digitally traded and functions as a medium of exchange, a unit of value, a store of value, right? So this is why I said it can have all those qualities of a normal currency, but it does not have legal tender status, right? Um, that is when it's tendered to a creditor, that it's not valid or a legal offer of payment in any jurisdiction. Right now, there are interesting subsequent developments to this definition, but these are still the valid definition because these are privately issued currencies, right? It is not issued or guaranteed by any jurisdiction and fulfills the above functions only by agreement within the community of users of the virtual currency. So that's why I said it is when something to be a currency, it must be accepted by the group of users. So for virtual currencies, it is a smaller group, but they all accept it as a currency. So they themselves, they can buy and sell within themselves because that's like their business, right? um, Virtual currency is distinguished from fiat currency, also known as real currency or national currency, which is the coin and paper or money of a country that is designated as its legal tender and is customarily used and accepted as a medium of exchange in the issuing country, right? So this is again we're still on the same point where it is privately issued, right? And it's not like the currency notes and coins, the central bank issued currency notes and coins that everyone is legally obliged to accept. Now, when we go to a shop, the shopkeeper can't, and we go and give them rupees. They can't say no, they can't refuse, right? But if we go and give them bitcoins, they can because bitcoins are not legal tender. Whereas notes and coins, they have to accept because under the law, it is law. By law, you have to accept it, right? As a means of payment. It is distinct from e-money, right? Now, we made this point before, which is a digital representation of fiat currency used to electronically transfer value denominated in fiat currency. E-money is a digital transfer mechanism for fiat currency, and this is virtual currencies are not a digital representation of fiat currencies. Right now, this whole definition is from the FATF 2014 guidelines on how to treat virtual currencies. Right now, the European Central Bank has also defined virtual currencies as a type of unregulated digital money which is used and usually controlled by its own developers and used and accepted among members of a specific virtual community. Right. So now what is the difference between a centralized payment system and a distributed ledger-based system or a distributed sort of cryptocurrency style system. Now here, the central bank issues the currency and it goes via banks to the customers, right? Now, in a central bank setup, in a decentralized setup, there are computers that are called ledgers that are all over the place, and then they are interlinked, and then there's a hashing process that goes through where you all verify that this transaction is correct, and then it goes to the intended party, right? So now let's go to the now from virtual currencies we are moving to cryptocurrencies. Now why are we moving to cryptocurrencies? Because within virtual currencies, cryptocurrencies are the most sort of known and sort of functioning at the moment, right? Others, there are examples for other types of virtual currencies, but cryptocurrencies are the ones that have really sort of dominated the world and challenged fiat currency, right? So I have directly pasted these from the article. So you, if you want, you can go and check out these links and find out more information, right? I have not gone to reproduce, not gone to rewrite anything. They're directly pasted here with the link. So you can access more information through this itself, right? So now let's see the history of cryptocurrency. Now, the whole idea of cryptocurrency started in the 90s, and people tried to see whether they can develop this digital um, currency, right? Then all those efforts by about 2008, we have the paper by Satoshi Nakamoto, which we saw last time, detailing about how to have this coin that solves this the problems that other digital coins had, right? And then in 2009, the Bitcoin was released, right? Um, and 50 Bitcoins are mined by Nakamoto, right? We do not know who Nakamoto is. It's like a pseudonym, right? Um, so then, so this is 2009. Now it's a big deal. Then 2010, the first ever purchase using Bitcoin occurs for 10,000 Bitcoins are spent on two pizzas, right? So that is the first ever. Now this is why Bitcoin is convertible. You can buy things with it, right? And this is to show that this is a proper currency that you can exchange, right? Then in 2011, we find that there is a big demand for the demand, sorry, not the big demand, the demand for Bitcoin starts picking up, right? So in 2011, the value, it was first like a few cents and no one wanted them and all of that, but then it started picking up. Now also note that this is happening at the same time that the financial crisis happened, right? So it was well timed. That was the other reason for its success. I have noted the impact of the financial crisis on this entire subject, right, of fintech and digitalization of payments, and this is a very crucial invention and innovation that happened um, as a result of the financial crisis, right? Then we have altcoin, right? Altcoin is any coin other than Bitcoin. Because Bitcoin is the cryptocurrency, right? Everyone knows Bitcoin. It is the first and it is the most established. Then others are all called alternative coins, right? Altcoins. So then Litecoin um, is launched in 2012, right? And then in 2013, the Bitcoin value passes $1,000, right? Now it's picking up. And then, so whoever still bought it even at that time is really up on the deal, right? In January 2017, Bitcoin value is still hovering around 1,000. But then we see in 2018 that it suddenly shoots up, right? Now, some of the benefits of Bitcoin at that time was that it was peer to peer, right? We didn't need an intermediary, and it was thought that it will be faster, right? But with time, we have seen that as more and more people, so each transaction has to be verified by all these computers. So when you have more and more computers in the system, the verification time takes longer. So therefore, though people thought it is faster, it's not faster. The benefits were not speed or power. It was things like it being anonymous, peer to peer, there not being a third party. Those were the benefits of Bitcoin, right? Um, Right. If you take cryptocurrencies, now there are so many cryptocurrencies in the world. You can go to these websites called Coinbase, there's Market Cap, Coin. There's so many Bitcoin cryptocurrency sites. If you see, there are various names, coins issued under various names, right? This is a trading platform. So, how can you get cryptocurrencies? So the main way that you can get cryptocurrencies is by mining. Right? So mining is a process where computers solve complex mathematical problems and a process of verifying transactions. Right. So when the transactions are verified, as a reward, the algorithm generates bitcoins and gives that computer that solve that problem, the hashing problem, bitcoins, right? So that is a way to get bitcoins. Another is purchasing it from exchanges. That is, so people who mine it and get these bitcoins don't just keep the bitcoins; they um, sell it on exchanges. And then you can have initial coin offerings. Some of these other cryptocurrencies have this thing called initial coin offerings. So now, what are the common uses for VCs? Right. So though they're called currencies, their most common use is not as a currency. Right. Their most common use is as a investment um, instrument, right? So as because most of the people, even if you know someone who's using digital currencies, virtual currencies, you will see that they are trading, right? They buy and they wait for the value to go up and then they sell. So it has the nature of security, more a nature of security than as a payment method. It's not. It's not very sort of. I suppose it's not wise to use a Bitcoin in these times because the prices are fluctuating, but they are also going up. So when they sort of all in all, they have a very high price. It's parting with it to like buy a pizza doesn't make sense, right? And then it's also used for cross-border payments. Most of the time, the value is transferred through virtual currencies, and then at the other end, they can convert it to the currency that they want. So when you do this, what you have to remember is it's not peer to it is peer to peer, which means there's no bank involved, which means there's no transaction fees, right? And you're not going through any intermediary, you're just directly transferring the money to the other party. Sorry. Hmm. So, are there any questions? Is there anyone here? Are there any questions? Anything that was not clear so far? Right. So we will continue. I think we will finish the lecture very fast today because we are not discussing any points as such, and we are just going through all the slides. Um, but of course, feel free to ask any questions. Not a problem. Um, so what are the risks? Right. So the benefits that people had stated were that they are peer to peer. Then there's no intermediary, there's anonymity. So for the users, it seems like a benefit, right? But there are a lot of risks involved, right? Which is why they haven't gotten accepted by regulators, right? So what are the risks? Why are there risks? So there are risks because cryptocurrencies don't have any underlying asset, right? It's just issued by private individuals, right? Anyone in the call wants to tell me what that means? Does anyone know what not having an underlying asset or a guarantee as legal tender means? So, what that means is now, previously, there was something called the gold standard, right? So, that means there is gold to back the value of the currency. When after that, that was let go, then you have a guarantee as a legal tender. Now, if you take central bank money, if you read what is on the note, it says the central bank guarantees to I think it's guarantees to give. Basically, the point is that it agrees to give back the same value that is on the face of the note, right? So that is what all central banks basically do. Right? There's a little wording on it. If you haven't read it, you can read it. So, cryptocurrencies don't do that. They're just coins that are just sent out to the world, to the internet. And when that happens, what happens is that it's just there. It's for us to do whatever we want, right? There is no obligation for us to use it to pay. No legal. There is nothing. No legal obligation to use it to pay, to use it for investment, nothing. It's like we have chosen to do what we want to do with it, right? Because it's called a currency, because it has these technological solutions to ensure its security and so that it goes to the right person. Those factors are there, so therefore we choose to use it. We can choose to use it as a currency, we can choose to use it as an investment. There is no legal obligation to use it as a currency, nor is there any right for anyone to demand us to use cryptocurrencies either. Of course, that is a different story. Demanding can happen, but we don't need to oblige, right? And because it doesn't have any macroeconomic factors or underlying asset to guide its value. Now, the value of legal tender is generally derived from the state of the economy, right? The inflation, so external assets, domestic assets. So all those determine the overall value of the currency, right? Of a legal tender. But in cryptocurrency, because it's not really connected to anything, it's just there. It's just something that's been released, right? uh, the price, there is no factor to determine its price. And a lot of the time we see that prices are determined by sentiment. And there are no market forces for, there's no sort of visible market forces for cryptocurrencies, mainly because, and another reason for that is because the use of cryptocurrency as a currency is very low, right? So there is no demand for it as a currency, which is then gets back to goods and services. It's just there, right? This leads to extreme volatility. Now you can see, now if you, this is the price of Bitcoin, just Bitcoin alone, from the time that it was released to 2020, right? Uh, so when there are certain these are the price volatility. Now you can see, uh, if you look at this date, this hasn't changed, stated it, but something may have happened, right? Now, what the volatility is captured in, now I'm taking this example of Elon Musk, right? This is what I mean by sentiment, right? So Elon Musk, if you don't know who Elon Musk is, he's the founder of PayPal, and then he founded Tesla. So he's like a technovator. Um, and so he has a large following of people, a large following of people who like to do like new digital things and technological things. So he said in 2001, he said uh, that Tesla won't take Bitcoin because they found that it was not environmentally friendly, right? Immediately after he tweets this, look at how the price drops. And not many people in the world even have Teslas, right? Very few people have Teslas. But what, and I don't know how many of those people were using Bitcoin to buy Tesla in the first place. Tesla is a car that is sort of now it's, I think, making its way out of US, but it's an electric car. Um, and you can see that the entire markets get affected just by one person's word saying that for one thing that is, it's not like people were buying milk or some major commodity that they buy all the time, and they said, oh, we are no longer using Bitcoin to buy that, to for that, accepting Bitcoin for that. No, it was just this random sort of market size would be very small in terms of quantity. So this is how much sentiment plays, because there's nothing to really anchor the value on, right? It's sort of itself. If people, when people demand more and push more money into it, the value goes up. If people start selling, then the value goes down. There is nothing, it's just sentiment, right? So that's very important point. And another reason the risks of virtual currencies is that there is no legal recourse. Now, in especially in Sri Lanka, we have very specifically said there is no legal recourse because it's a private transaction, right? So if something happens to your transaction, it's lost, right? There's no one to guarantee the value for you. But of course, this is, it's very important because in other countries where it's used as a security, there is recourse, but in Sri Lanka there is no recourse, right? So look at the volatility of this is as at 23rd, that because I prepared the slides for the 23rd lecture. So it's um, I have taken the screenshots from the 23rd. So you can see how volatile the price is, right? This is from 2015, 2014 onwards, right? Look at how the volatility of the price. And this, right, I just wanted to, so to show you um, how volatile the price can be, right? So look at the high and the low. This is the daily high, right? It's like a $2,000, almost a $2,000 difference within the high and the low for a Bitcoin within a day, right? This is how volatile the value of Bitcoin can be, right? So at the time that I was taking the screenshot, right? Um, on that day, the value of Bitcoin was at 38,000. So when we look at again the high and the low, now this is in the morning. So whoever bought at this level is very lucky, and whoever sold, let's say someone sold, bought it here on the same day, let's say someone bought it here and sold it here, it's a complete loss, right? But let's say someone bought it here and sold it here, then there is a slight gain. But you can see overall how unpredictable and how volatile the price is, right? Um, so now the Bitcoin market has dropped, right? You can see it was at this point. So this is the 68,000 point when it went at all-time high, and now it is just somewhat what they say is it's the price is sort of stabilizing at a normal rate. It's normalizing slowly, it's coming down. So the risks of virtual currencies will go by go from one to one. So anonymity, right? So one of the benefits is anonymity. So people don't know that it's you who's doing these transactions, right? There is a joy in being anonymous. But this has led to a lot of crime, right? Especially anti-money laundering and terrorist financing violations, right? Now you can see a New York couple. This is very recent. This is in this month itself. The New York. This is the biggest money laundering, crypto-based money laundering case that took place. They have laundered $4.5 billion worth of crypto, right? So this is where you buy so money laundering happens where you you take the illegal money, you buy crypto, you're anonymous, you don't have to show your source of funds, you buy it, and then you sell it, and then you get clean money, right? So this is how you can do how people engage in illegal activities, right? Says crypto money laundering rises by 30%, right? This is also this year, right? Um, and it says in 2001, $8.6 billion, right, of crypto was laundered, right? So just see how much it's being used for money laundering, right? And another is scams, right? So crypto can be used for scams. We've again there is a slight maturity in the market. We can see in 2019 there's been a lot of thefts and frauds, right? Scams, and then it just sort of reduced into 2020. But what they're saying is it's kind of normalizing, but it is it is happening, right? So the relative amount is rather large, right? So crypto scams fall into two categories, right? So I use Investopedia here just to keep this very simple for you. I don't want to go into sort of formal definitions, just so that you can understand the concept very easily, right? So initiatives aiming to obtain access to the target's digital wallet, right? And their scammers try to get people to give them access to their digital wallet, which has the cryptocurrencies, right? And give the passwords and security codes, right? And other is transferring cryptocurrency directly to a scammer due to impersonation, fraudulent investment, or business opportunity, right? In 2019, the Ponzi scheme plus token netted 2.9 billion USD with its exit scam. 64% of the year's major crime value, right? And then in 2020, saw War token, a similar scheme to Plus token, operated by the same people as the Plus token crowd, defrauded 1.1 billion USD with its exit scam, right? So, pyramids, cryptocurrencies can very easily be used for Ponzi schemes, right? Because there is no underlying value. There is, you should just be lucky that there is someone else there to buy what you're selling. That's because some people just stop. Uh, and so it can be very easily used for Ponzi schemes, which are illegal, right? And the other risk is hacking of exchanges. So because of the cryptography in digital currency, the digital currency itself, there have been no news of digital currencies being hacked, right? But digital currency exchanges have been hacked quite a lot, and a lot of people buy their digital currency from exchanges, right? So the first such large hacking was the Tokyo-based cryptocurrency exchange called NTGOX, right? And they filed bankruptcy after losing $500 million worth of Bitcoin, right? Then another exchange called Ubit, based in South Korea, was hacked twice in 2017, subsequently filed for bankruptcy, right? Because when you lose all your tokens, you have nothing to sell, right? People want their money they have bought. Um, and this shows how severe the situation for exchanges can be, right? So you can see here the biggest crypto heist, that's the thefts in the history. So you can see what the MTGOX is here, right? Then Poly Network, there's 611 million USD. It's so imagine how much money people have also already put into cryptocurrencies, right? There's a lot of money being put into cryptocurrencies. Um, and then the largest ever cryptocurrency hacks, right? So you have Qcoin here as well. 146 million hacked by the Italian from the Italian exchange, right? And then Polynetwork is a Chinese platform, right? The hacker returned all the funds and customers started being reimbursed. So this is the very interesting thing about this. Even MTGOX, they came up with a plan to reimburse the customers because otherwise customers would completely lose faith in this new system, right? So to get the customers involved, there has been a lot of ways to protect customers as well, right? So we'll stop there for about 5-10 minutes. And what's the time now? So let's be back at 2:40. Are there any questions so far? Is it clear? If you have any questions, please feel free. Even after the break, you can ask them. I've sent the PowerPoint for circulation. I don't know whether it has already been uploaded. So this is a very important topic. So please, if you need any clarifications, just ask. Right? Thank you. So we'll be back at 2:40. We can start. So far, are there any questions or any clarifications or any observations that you would like to make? Right. So let's continue. So how are these, now we discussed all these risks, right? So how do we avoid these risks? Now what we have to understand is virtual currency, a lot of people putting a lot of money, right? You saw the value of uh, of uh, of virtual currencies. Now if we go to look at the market cap, uh, um, so if you go to coin market, right? look at the market capitalization. That is the total amount of cryptocurrency that's been bought today, right? So far. Uh, there's been a price dip, right? And it's picked up. Tether, we'll be talking about things like Tether later. Now look at uh, the total market value of cryptocurrencies circulating supply, right? Um, so market cap is current price into the amount that is being circulated right now. So the amount of cryptocurrencies that have been sort of issued, right? Um, you can get more information when you go to these sites, right? So look at this, right? Then you have how much cryptocurrencies were traded, right? Look at this. So, and then the value. Tether is pegged to a dollar. So, you will always, the price will look like it's $1, right? Um, uh, yeah, right, here we are. So we had the risks of um, volatility, then illegality like AML, CFT issues, scams, frauds, not being legal tender. Then how are these issues resolved in a virtual currency? Now, what the reason I showed the market cap was to show you how much people have, that's trillions of dollars, right? Trillions of dollars. So, and then when we are in such a situation, how do we how do we keep the validity, right? Because the credibility of that coin, right? So acceptance, when there are scams happening, when there are, it's called illegal, then people might lose faith, right? Now people have already invested a lot of money, right? So and also these coins, they have some good qualities, right? They are very, technologically, they are quite robust, right? The coin itself is very difficult to hack because it's encrypted, it's hashed. It's there's a big process to ensure the security, just like, in the money, the cash, the currency notes and coins, there are ways to prevent, security features to prevent counterfeiting or to identify counterfeiting. Just that way, there is a more advanced system within these cryptocurrency, the Bitcoin and subsequent coins, to ensure that security of the thing. So this is very robust, technologically it's very robust. It's just conceptually and in terms of economic principles and in terms of usability, in terms of like the ability to the guarantee of value, right? The guarantee of value, the guarantee that it will be useless for crimes. Those are things, those are non-technological aspects, right? Those are the things that can't be resolved easily, right? So to resolve those, people have been now, from 2008, this has been around, it's been popular from about 2013. So people have been constantly developing the concept to resolve the shortcomings or the risks or the weaknesses of this cryptocurrency, this privately issued. um, systems. Some of those ways that have been presented now, that are available now in the world as solutions to this, are issuing stable coins, then bringing in regulations, continuing to distinguish, like not call them legal tender, so that people don't get the wrong idea, and then issuing central bank digital currency. So it's going the full circle, right? So it started off as a virtual currency with no centralized acceptance. But now central banks are also issuing digital currencies because they have seen the technological potential in it, right? So let's look at each of these. So stable coins. So what are stable coins? Now I told you we'll come to Tether here. Now Tether is here. You can see Tether here, which is $1 in the market cap in this one here. Tether is $1. Now you can see you will see why Tether, USD coin, why those are $1, right? Because those are called stable coins, right? So stable coins are a class of coins. It's a class of cryptocurrencies, right? They are also virtual currencies that attempt to offer the price stability. So we saw that volatility was a big issue, right? The price is always fluctuating, even in the Bitcoin, which is like the most popular and with so much demand. Still, its price is constantly volatile. So to avoid this volatility, they came up with a coin, because remember, the coin itself is the technology, right? So that can remain. It is the non-technological issues that go around the coin that is creating that is weakening it. The technological coin itself doesn't have the issue. So backed by reserve assets. So just like in fiat currency, or previous fiat legal tenders which had gold reserves, backed by a reserve asset, right? So stable coins have gained traction as many attempt to offer best of both worlds. That is the best of the private issued currency, the flexibility of the private issued currency, but also the stability of a fiat currency, that is central bank issued currency, right? You can add the links are all there. I put this Investopedia links because that is they explain these things very simply, right? If you want more complex ones, you can go to the BIS site. They have a lot of research. Then ECB. They are also fairly simply written, but this I find is quite sort of straightforward, because the purpose is to sort of introduce it at a very basic level, right? Um, so there are types of stable coins. So fiat collateralized stable coins, right? That is, they are pegged to a fiat currency like the US dollar, right? That's why Tether and USD, um, yes, these two. So Tether, the other guy was one. Oh, this is lost. You see, just as we were, which was $1 when we looked last, now it's dropped from $1. But it is also a pegged. So Tether, it's pegged to the dollar, right? So you can see the movements. So it's largely in line. So it there's very it's got the band is rather um, let's see. You can see the value is always around $1, right? Because that's the way. I think there is a smart contract or something that doesn't allow it to go beyond these values, right? Yeah, it doesn't go beyond, just slightly going beyond $1, and now it does just over one. Yeah, just under one. Yes, it's this is losing here as we are watching. It's losing the value. Um, so yeah, so these are stable coins, right? But it is, you can see that it is, the fluctuations are very limited. It is within the dollar. The value is getting um, value is within the dollar, so it won't, because it's pegged to a dollar, right? Um, then you have commodity collateralized stable coins. That are backed by gold and oil and other commodities. So, but it reserve asset to peg to its value. So the basis is, if something happens to this digital token, the people who are owning it have something to hold on to, right? It doesn't just disappear, right? It doesn't just disappear. Um, so, for instance, if you tear your money, right? If you can bring the torn pieces to the central bank will give you another fresh, uh, a fresh note, right? It's same at the banks. You all do it for your customers. So I think you do it for your customers. I'm not sure. Um, and So it's the same concept, right? So the customers won't lose their value just because something has happened to the coin, and the value itself of it is maintained. So it doesn't go through the high volatility, right? The high volatility now if you bought it now, if you bought Bitcoin today at 38,000 and then suddenly it drops to uh, like 20,000, it's a huge loss, right? So you can't keep it as a you can't use it as a means of accounting. If the currency value is fluctuating a lot, right? Now let's say you're making accounts, we put a accounting value and then we can depreciate it, or we can adjust it with inflation, the value of the assets, but it's largely in line, right? But if you're having constant fluctuations, you've said, okay, my assets are now, I have one Bitcoin worth of assets, and then next day, if you let's say you have 10 Bitcoin worth of assets, and then next day if the same assets are now 5 Bitcoins, just because the Bitcoin's value has changed and not the assets, and nothing has happened to the asset, then that's a problem for accounting, right? So that's why we need, for practical purposes, they need to come to this stable point, and this is why stable coins have come about, right? And then some are collateralized to other cryptocurrencies as well. And at that point, they sometimes put a smart contract where you issue and where you control the issue number of stable coins issued to manage, right? Um, and then, of course, you have the algorithmic stablecoins. That is where you have actually where you have the smart contracts themselves to regulate this supply, right? So, if there are too many, if the if the volatility is like really high, you can manage the amount of stable coins that are getting supplied to the market, right? So the next one is regulatory framework. Now this has been there for some time, right? Now when I mean some time, I mean it's from about 2013, 12, 13. But it's because of the internet and because global you can buy. cryptocurrencies, it's affected the entire world really fast, right? So within a span of about 5 6 years, it affected everywhere in the world. Any place in the world that had an internet connection, cryptocurrencies were affected. And because its value was so high, people quickly, because people want to make money, right? So people will go and buy cryptocurrencies. So it affected everywhere, right? So you can see the type of regulations that are available now across the world. Yellow is where there are tax laws. Tax laws are particularly important where they are recognized as assets, right? Where when you are going to earn money, you should get taxed, right? So in many countries, tax laws are there. And blue is anti-money laundering and terrorist financing laws, right? So countries that have recognized, okay, there is this anti-money laundering, terrorist financing issue, so therefore it's under those you have to check them for those, right? So in Sri Lanka is colored under blue, right? And then you have both, which is the countries that are green, right? So India also has tax laws regarding earnings. Um, so what is the regulatory stance of regarding virtual currencies in Sri Lanka? So in 2018, we issued our first press release warning the public about the risks associated with using cryptocurrencies, right? And we told them that there will be no recourse from the central bank, and there are AML safety risks, right? And that's why we have a blue coloring there, because this kind of it it really signaled to the market that the central bank will not be that you will not be exempt because you are using cryptocurrencies, right? So the issues of money laundering goes to any money value transfer mechanism, right? Any way that if you are transferring value, um, it's money and value transfer, right? So if there's a transfer of value, then you get caught to AML CFT. So that's there in Sri Lanka. And then again, we made an updated press release in 2021 where we clearly stated all the risks, right? And by that time, we had also issued a regulation in terms of the Exchange Control, Foreign Exchange Act, right? Regarding uh, EFTCs, right? That is electronic fund transfer cards. And we had very clearly stated here, therefore, the public is warned that a significant financial, operational, legal, customer protection, and security related risks posed by investment in VCs to users as well as to the economy. The public is also informed that CBSL has not given any license authorization to any entity or company to operate schemes involving virtual currencies, including cryptocurrencies, and has not authorized any initial coin offerings, mining operations, or virtual currency exchanges. Right? That has been our regulatory stance, and that continues to be our regulatory stance now at the moment as well. The link to the 2008 press release is here. You can search for the same for the 2021 release is also here. It's the entire release is pasted here, so I haven't put the link. So this is the foreign exchange regulation. So it defines virtual currencies as a digital representation of value that can be digitally traded and functions as a medium of exchange and or unit of account or a store of value, but doesn't have the legal tender status in any jurisdiction and is not issued or guaranteed by any jurisdiction. So now this definition is very similar to the definition in the FATF, that is the um, financial task force. Let's see what FATF stands for. FATF is the Financial Action Task Force, right? That is the international body for anti-money laundering and terrorist countering terrorist financing. So yeah, so that's the same definition that is kind of like in the first slide. Yeah, and under that foreign exchange regulation, it says that authorized dealers of to issue, so authorized dealers of foreign exchange. So for transactions with using payment cards, right? So electronic fund transfer cards are all payment cards, that they cannot be used for payments related to virtual currency transactions. So what that means is that you cannot buy virtual currencies from exchanges, because all these exchanges are abroad. Sri Lanka does not have any exchanges as such, using your payment card. So you can't use foreign exchange to buy virtual currencies through your cards, right? So I think all the banks have blocked that. Wherever they can identify that it is a virtual currency exchange, those transactions have been blocked. If it has not been blocked and you are aware that such virtual currencies are being purchased, you're in violation of this direction and you must stop that, right? And yeah, so that is, so how would a bank explain the legal tasks relating to VCs? Do we have? What, there's three of you, you can answer if you like. Do you all get queries on virtual currencies at during work? Do customers call and ask you about virtual currencies? No. So I mean, a lot of people do contact us regarding virtual currencies, and we explain this to them. Basically, what I've explained to you. Because a lot of people want some sort of guarantees. People are unclear. People want to make a lot of money, but they also don't want to lose their money. There is a big risk that you could lose your money. Also, a lot of scams going on, and a normal person, it's not so straightforward. Sometimes you can lose your money because you simply don't know what you're doing. So if you don't know how to use, if you're not conversant in the area, it's better to not risk it. Of course, there are people who do, we are aware that there are people who do it, but that is completely at their own risk. And a lot of times, what we see is there are people who lose money, but a lot of time, people who speak out are the people who make the gains. People who lose money are kind of shy to say that they, risked all their money and they lost it. But so we don't hear about it. But if you go to these cryptocurrency exchange sort of chat rooms and things like that, you will see people talking about how they've lost their money. So it's usually, but the stories that we hear is like, oh, we made so many gains. But you can, as you saw the volatility in the prices, you can make the gain if you buy and sell at the right time. And there is no logic to that, right? It's pure luck. So it's like a real gamble. So if people have, you need a high risk appetite for this, and that's why central banks don't guarantee that at all or advise people to use to engage in such risky activity. So legal tender status, right? Now we saw in the definitions that they have been looked at as currencies without a legal tender status, right? So without a legal tender status. But now, and that this is correct, in most countries, they're not legal tender. In like 99% of the world's countries, they're not legal tender, right? They are recognized as assets, and that's why they get taxed and they get regulated under the securities laws, right? But we saw that in 2021, El Salvador made Bitcoin their legal tender. Now, El Salvador has an interesting case, right? Its economy has been in a bad state for, I think, over a decade or so. And in 2001, it had taken the US dollar as their legal tender. Usually, when you take another currency like the US dollar as your legal tender, that means your currency has completely lost value, right? You have no control over it. It's become almost meaningless. So that's why you adopt another currency. Because the point is you have no control over the monetary policy of that other currency, right? Like El Salvador just has to manage to get US reserves and use US dollars directly. Basically, whatever earnings that they get in dollars gets pumped directly into the economy, right? Without it there being any conversion. So the prices are basically along the lines of the US dollar. So, so El Salvador has this really young president, and he promoted Bitcoin as a way for residents to save on remittance commissions. Okay, it has a big sort of migrant working group and expand access to the financial system to bring people into the financial system, right? The IMF, nevertheless, they brought in a law. There's something called the Bitcoin law. So if you go to El Salvador Bitcoin law, it's always top thing here. IMF urges El Salvador to so it was passed in June 2021. And just trying to find the law itself. I saw it the other day. So, if you are interested in, you can find the Bitcoin law. And so the IMF has basically told, so it's already under an IMF program, I think, El Salvador. I've told them to not use it as legal tender because, as we discussed, it's not centralized. So there is even less control over the value of Bitcoin, right? At least the US dollar, US is a global reserve currency, so it has a very stable value, right? It has a very stable value because it's the dollar. But if you take Bitcoin, it's highly volatile. And El Salvador is not a country that's rich enough to influence the value of Bitcoin at all, right? Nor does it have so much trade with the rest of the world. So, in that, it could have huge risks for the financial system stability and integrity, and also for the country. Because when consumers have that money, your value of your assets could decline really fast if with the volatility, right? So people could become poor instantly. and not by trading, just by holding a coin that they have no control over, that the government has no control over its value or a responsibility as such, right? But of course, what El Salvador has done is it has put a reserve to give it like a stability, right? So whatever amount of bitcoins that are there in the market, they are giving a reserve, but it could seriously deplete the value or the reserve in that country as well, right? So it's a bit of a mess. So a lot of people are watching El Salvador to see how this works, right? Some people are saying don't do it. Others are just like, okay, you have gone ahead with it, so we'll just watch you and see what happens to you, right? Kind of like an experiment. So sorry, we are. Uh, this will be. Why did I have this? Um, no, this is. I need to. This is this slide. I'm going to discuss it next time. Um, and then we have central bank digital currencies, right? We're going to discuss central bank digital currencies. So far, are there any questions? If there are no questions, so the next level is the next solution to the problems that virtual currencies bring across is is central bank digital currencies, right? So it's gone, as I said, it's gone the full sort of circle, not the circle, but yeah, I suppose circle. You know, the virtual currencies were introduced to go against centralized, you know, uh, currencies where central authorities control its value and all of that. Now it's going the full circle where the central bank, the central authority, is now developing its own digital currency, right? So it's a digital version of the fiat money, right? So instead of notes and coins, there will be a digital token, right? Um, of course, it will create wider online access to central bank money, and it could create more opportunities to banks, right? For banks and customers to access central bank money, and also to sort of conduct I don't know, more transactions, or finality will be more immediate. There won't be the settlement process, the deferred settlement, and all of that. But it all depends on the model, right? People are still trying to figure out how this will work, right? And you can see how many central banks are looking at this. Um, let me go to this website. So if you go to now, these are all the countries that have been officially. Now, we Central Bank of Sri Lanka has also studied CBDC because we study all these developments, but we have not made any official statements or anything like that. But these are the countries that have been studying or the studying central bank digital currencies, right? Now, uh, most of them you can see They're at a proof of concept level, right? You can see the countries. Of course, this is, when Russia does it, the whole European continent turns. So Kazakhstan, Ukraine, Hungary, Turkey, Iran, Sweden was very early, and they've still in a very late stage. So if you go to Sweden, so the interesting thing about this whole map is that you can go and get details, right? So the e-krona is probably like the first project to start for digital CBDCs, but they didn't rush to launch it, though they started first, right? They just wanted um, to see how it goes. And interestingly, they have been running a pilot, and they haven't still launched their e-krona, right? And Sweden is a like a almost like it's a highly cashless society. They use digital payments a lot. So if and in Sweden, the by law you can refuse currency notes and coins. Not refuse fiat currency, but you can refuse currency notes and coins, right? So there are some countries. So Ecuador seems to have cancelled their project, right? And so has Denmark. E-krona has been cancelled, right? So Sweden has e-krona, and Denmark, which is also quite a cashless country. Let's go and see what happened there. So Denmark in 2016. Um, So they felt, now it says here that the central bank felt that the potential benefits of introducing central bank digital currency for households and businesses in Denmark would not match the considerable challenges which this introduction would present, right? Citing Denmark's existing secure and effective payment infrastructure, the report noted that efficiency gains do not outweigh the risks of stability. So a lot of countries are studying these, and we've taken a sort of a wait and watch approach to see where this is going, right? And a lot of countries are also using it as a now you have in the same sense there are countries that have launched, right? So e-naira and the Bahamas, the e-naira is in Nigeria, and the Bahamas they have already launched CBDCs, right? Already launched CBDCs. So um, um, So this is what I've said here. Bahamas launched in 2020, Nigeria launched in 2021, and China launched a digital pilot, which is and China so there are digital pilots in several countries as you saw. But I put this here because it's a big deal when China did it because it's such a large economy, and they launched it in line with the Winter Olympics so that people can use it there, and everyone was given some yuans to use and see how it goes, right? So China has also banned cryptocurrencies, right? So China really saw CBDCs as an alternative for cryptocurrencies. They present it as an alternative for cryptocurrencies so that um, if people want these digital currencies, then they can have the central bank one. That was, I think, basically what China was thinking about. Because the problem with digital currencies, they're outside. They're pretty much like a leakage. If you allow digital currencies, I think in the first lecture we talked about leakages from the economy when people go outside the formal currency system. right? So when you're in the formal currency system, so taxation, then payments like all these welfare payments, everything happens within that currency set, right? But and so they keep coming back into the banking system, so that flow happens. But when you have an alternative currency going on, they don't flow into this currency system, and the economy can't be managed properly because there's leakage, the money just going out and not coming back in. So the circular flow gets upset if you have alternative currencies functioning in the economy. That's why the term legal tender is there, because if there are multiple currencies, the circular flow doesn't work in the economy. So this is why China launched this digital yuan. So, possible benefits. The reason I use the word possible is here is a lot of them are hypothetical. We are assuming that there will be these benefits, that there will be risks, but until they're actually used and we see how people use them, we can't really see them, right? So benefits are the reduced cost of cash. That is one benefit, because printing cash and maintaining cash is quite costly. But of course, the other side is maintaining the digital infrastructure to run CBDs, because these are very sophisticated technologies. That could be even more costly. So you have to compare the two. Then financial inclusion, because especially this financial inclusion for people who are living far away, like the e-money concept where you can't get to a bank, but uh, if you have digital wallets that are sending back your actual tokens to your wallet as opposed to money that is held with the bank. Now remember, in a CBDC, the money won't be held with the bank, right? It is held with you yourself, right? The money is directly coming into your own wallet, just like cash. It's cash, right? So the other question is interest bearing. Now, when you're holding money in a bank wallet, you're getting interest for it because it's pretty much a bank account. But if you're holding money in the CBDCs, you won't get interest. I mean, you shouldn't get interest because you're holding your money. No one else is holding your money for you. Then stability of payment systems when operated by central banks, right? So one issue with payment systems right now, one is virtual currencies, it's completely going outside the system, and the other is even the current system. There are a lot of companies that get involved in the process for validating the transactions. So this way it's sort of peer-to-peer, so directly central banks would be operating these systems, or that's the way it's. Maybe subsequently there will be intermediaries again, who knows. And another big reason is countering VCs. There are pros and cons. I mean, yes and no. Yes, because if some people want to hold these digital coins, then yes, they can use the CBDCs where the value is guaranteed. They can trade them and they can transfer them just the same way as VCs. But the other is, if you're using a VC um, for these sort of irrational gains, as investments, then you're probably not going to get the same return. So you need to see both sides. Whether it will counter CBDs or not is something that we need to see. Of course, that is one of the uh, points where people say, oh, we don't trust the banks, we don't want to keep our money with the banks, so we're using VCs. And the central banks are like, okay, fine, don't keep the money with the banks, here you go, here is a digital token, keep the money in your own digital wallet, you don't have to keep it with the banks, right? But stay within this system, right? And then, of course, it supports distributed ledger, and this is a benefit because, as we studied last time, there are many beneficial aspects of the distributed ledger technology, and which makes sure that double spending and the hacking, all those things can be avoided. So, because most CBDCs are looking at DLT-based systems, that is a we can get the benefits of DLT as well. Then possible risks. The banking sector could get disintermediated, right? Because it's now peer-to-peer and central bank is giving money directly to the customer, so it could disintermediate banks. But we'll see, people need loans, right? So people want interests. People want interest, like for their savings. So let's see. I mean, these are all, as I said, these are theoretical and hypothetical, right? Mm, and then run risk. The people could now, since they have the wallets, they could again, do a like a bank run sort of thing. But because of all the stability issues and all of that, it might not happen. It's unlikely. So we can read this blog. It's a short blog from the IMF discussing all these points, right? And then costs and risks to CBs, because CBs will be operating these systems, right? So they are directly giving the money to the consumer. So there are risks involved in that. And then you have international implications, which is something like then what are the reserve currencies? How do you trade? If you can just transfer money across now, you have to convert the money and send them, and then there are correspondent banks and all of that. So what happens? Like what happens when you can do peer-to-peer transactions? What happens with that whole system and the guarantees that come in international trade. So those are the benefits and the risks. You can read more. I put the link. And yeah, that's all for. I'm going to stop there today. Um, and do you have any questions? As I said, I didn't. As I said at the beginning, I didn't stop for any questions or any discussions today because people were dropping. And last Tuesday, Wednesday, we had this problem. We couldn't have our lectures. So I just decided to just continue this as a recording. And if you have any questions, you can ask. But there will be questions from this at the exam. That's why I gave a full lecture for this. Are there any questions? Feel free to ask, or any clarifications or any observations that you've made regarding this. Right, so we will stop there today. And what shall we do? All right, so next time we will look at I have brought in a slide by mistake of the next lecture, which is data protection. So we will look at the new laws that enable fintech and all these new innovations, such as data protection. And then we'll, just for completeness, we will touch on the other ancillary laws like FIU and all, and see how they um, affect digital payments, right? And how they have also changed in line with technological advancements. We will look at that to kind of close up that will be the last lecture. Like next time will be the last lecture, the lesson. And after that, we will have a revision and we will be completing the course. So if you have I've shared all the slides. So if you have any questions or any clarifications, you can either bring it next time or the time after. And they have also uploaded last year's question paper, so you can see what it is like. And if you have any questions, I won't be giving any model answers. I don't do that. for two reasons. One is I don't need to see my own answer, right? That's on the purpose of the course. So I do not give any model answers. Last time some students asked for it. I'm just telling you in advance, I don't. They lectures, right? But of course, what I noticed from marking the past year was, of course, those who were involved in discussions had answered better. They had done quite well because, of course, it was a very sort of a chatty group.